Good afternoon, this is Ken Long from Tortoise Capital, and we want to try a sample visual framing technique using our regression line fractal 4 technique. And so we find our list of favorite trading targets and we compute a forecasted value for the 10-period regression line, F10, the 270-period regression line, F270, and we find the difference between those. And we compute an opportunity raw dollar value, op raw, an opportunity percentage, taking that opportunity as a percentage of the current price. We're going to compare that to the ATR percentage for volatility and come up with what we were calling the opportunity ratio, or a reward to risk ratio. And so I've taken the two extremes of the report, and we'll look at the VXX, which has a 10-period forecasted price of 30.52, forecasted 270-period price of 15.96. There's a $14.56 opportunity in the VIX, which divided by price is 47.5%, and with a 2.33% ATR percentage gives us a ratio opportunity of 20 to 1. 20 ATRs potentially available. At the other end of the population, we have CLF, Cliffs Natural Resources, which has a 10-period forecasted value of 14.26, a 270-period forecast of 21.54, which gives us a 7.28 raw dollar opportunity, which is 50% of its current price, which is at 14.25. And with a ATR percentage of 4.49%, that gives us an 11 to 1 reward to risk ratio. So we're interested in Cliffs Natural Resources. Let's see now. Where is it? There we go. Now, when we analyze the frog statistics for Cliffs Natural Resources, we know that a daily frog box is 20 cents, a weekly frog box is $63 cents, and a monthly frog box is $4.15. On a relative scale, this is what a daily frog box looks like. And so now we're going to take a look at Cliff over the last 2 years. The pink line, the purple line, is the 270-period regression line. This gray shaded river-looking object is a one standard deviation 30-period Bollinger Band on the 270, which we treat as noise. The green line is a 90-period moving regression line. The black line is a 30-period moving regression line. And the blue line is a 10-period moving regression line, which we use as a proxy for price. The orange shaded ribbon is a 2-period Bollinger Band, which basically maps out the real body of the candles all along the way, but cleans up that display so we're not startled or confused by green and red lines in the candlesticks. So what we've seen is Cliff over the last 2 years has moved from a price of 15 eventually to 30, and now back around $14.70. And now we know the characteristics from the frog box for its typical daily, weekly, and monthly moves, and the noise filter. And so now let's see if we can't visually frame this idea and see why there's an 11 to 1 reward to risk ratio on this rascal. So the first thing I might do is test. I think the price could come up and retest the high around 29, and maybe the bottom of the channel. We could project this 270 across in the bottom of the ribbon and the current price. If that's near the swing low, then we now have a channel from about 14 to 29. That's a $15 or $14 channel. And so if price were to reverse here, we might wonder how far up it could go before we have the difference between signal and noise. If it just bounces up and then fails again, well, that would obviously be noise. But if it retraced all the way up to 29, then we'd look back and say somewhere in there we had to decide that it was time to get in, that what we had was a signal of a reversion to the top of the channel. And so we want to define that. Let's take a look at what we might do. We might say that instead of using the return to 30, we might take a look at this resistance level. That's where the 270 rolled over. It was at a recognized high. So now maybe our channel is from 23 to 14.5. But even that might be too high, because what we have is a clear evidence of a downtrend pushing the bottom of the channel, and so there's not a lot of belief in a return to the 270 up at this peak. The 270 is actually retracing. So what if we extended that downward? We might say at the time of framing the trade, we will use $20.50 as our objective measure of the 270 and a price target. And now what we've got is a price target in here. A single frog box of 20 cents might not be enough retracement to convince us it's time to get back in. What else might we do? We might take 2 monthly frog boxes, or I'm sorry, 2 weekly frog boxes, each one about 63 cents. And we might also compare that to this $4.15 monthly frog box. Now, if we were to get in here, we'd give up way too much money for a projected target of 20 and a follow-on target of 23. So somewhere between a daily frog and a monthly frog, we probably want to enter. If we simply took and divided this channel from 14.5 to 23 in 3, we might say, we might do it this way, sorry. And give this a little wiggle room. And now if we can buy a tactical price reversion south of this blue line, then we feel like we're going to have at least 2 to 1 on a test to the top of this ribbon, and try to capture this 1/3 in the middle between the blue line and the purple line. That's really the price capture that we'd be very happy with. And so either some multiple of the daily frog or multiples of the weekly frog would allow us to get a tactical retracement. We might even be willing to use price crossing over the 90 period regression line and then use that as a price entry level. Now, one thing that we know is that if it can move, if the frog box for a month is $4.15, it might move in the month of June this far to get up to that 415. And so by that reasoning, if we could enter somewhere around 16.5 or 16 and saw a move to 1850, we would certainly want to capture that move. So we're going to be sensitive to the fact that this is still in a price decline and that the 270 is going to degrade, and so we might frame our trade for comparison purposes against the current reading of the 270, but also acknowledge as we manage the trade, once we're in, that our target is decaying as time goes by. And so we will adjust our expectations based on price action. So inside this blue box, you see the different choices we might make based on frog statistics, and then we might make some choices based on just pure price levels and money management strategies, where we're going to risk 1/3 of the channel to aim for 2/3 of the channel and then accept 1/3 of the channel. Now, why should we be interested in this? Well, one of the things that you notice in the frog statistics is that the difference between the daily and the weekly is about 3 to 1 ratio. 3 frog boxes almost equal to a weekly box. But there's about 21 frog boxes, the dailies, inside a monthly. And what that is characteristic of a target that once it starts swinging makes long swings, which you can see in these kinds of moves. And then makes this kind of swing, makes this kind of swing, and then reverses those and makes long swings in both directions. And so this makes it an ideal candidate for swing trading one day at a time, because you have a relatively tightly defined daily frog box, reasonable lengths on the weekly frog box, ratio better than 3-to-1, and extraordinarily large monthly boxes, which allows for a swing trade to unfold over time and allows you to add to positions as you go. And so specifically the reasons we're interested in, we would call this a nearest neighbor analysis. These are all places where once the weekly and monthly swing was over, you had tradable moves off of observable bottoms, many of which last for long periods of time. And so Cliff stands out for us on the basis of that kind of analysis. We begin with taking a look at the size of the opportunity that's computed on a statistics-based measure that is not immediately apparent to people using conventional charting packages. And we include a measure of reward to risk, and then on the basis of trade location we can compute a ratio, and then depending on if we're interested in taking the long side after an extreme move down, or the upside after a long move down, or the downside after a long move up, such as in the in a VIX ratio, we would be postured for that end of the curve that is of great interest to us. Now, the exact opposite of this trade occurs when you have all of the 4 regression lines packaged together nice and tightly, and then everybody in every time frame is satisfied with the current fair value of price. And then what you're looking for is the slope of those regression lines and looking for the excursions to begin. And when that happens, you have the opportunity for the train leaving the station in the direction of the previous trend, and then you can stay on that as long as it's available. That's another video for another day. So that's everything for today from Tortoise Capital. This is Ken Long, Kansas City. Keep your risk measured and your powder dry.